It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hi, welcome back to the series on Bitcoin. I'm your host, Mark Yegge. I hope you're enjoying this so far. Now we're going to start going a little bit faster, getting into the nitty gritty of what Bitcoin is so that you can understand it and have a conversation with people. You know, I've spent thousands of hours figuring all this stuff out, and it's still a little confusing. I have to say, it's a new field, right? It's like, an encyclopedia of a new field. It's like when the internet came out. Anyway, let's go into what is Bitcoin. Now, we know that Bitcoin has all those characteristics that we talked about in the prior videos, but let's try to define it a bit, just so we have kind of a definition going forward. So what is it? Well, the way I see it is a global, trustless, scarce, decentralized, electronic, peer-to-peer currency blockchain technology modeled after gold that behaves like electronic cash and can be used by anyone without permission and with minimal cost 24/7. Sounds pretty good, right? That's why Bitcoin is so compelling if it has all those characteristics. So what else does it have? Well, we've talked about scarcity, so it's deflationary in nature. In fact, only 21 million Bitcoin will ever be created between now and the year 2140. I think currently, as we sit here at the end of 2022, we're looking at 19.2 million Bitcoin that have been created. So there's a big runway to create the next, almost 2 million Bitcoin. In 2020 to 2024, there were 12.5 Bitcoin mined every 10 minutes. So that's what they call the hash rate. That's how many Bitcoins are mined every 10 minutes. And they have that every 4 years. In 2024, what they're going to do is they're going to take that 12.5 to 6.25. So there's more scarcity, more competition for the mining. So 21 million Bitcoin will be created between now and the year 2140, and therefore miners use energy to solve complex mathematical problems to compete to receive Bitcoin. That's how Bitcoin is created, right? In gold, if gold is worth something, you have a mining company and they go out and they search and dig and find a mine and strike gold and then hire people to extract the gold. There's costs involved in that, right? That's work, right? And then you basically take that work and translate it into your reward, which is gold. That's called proof of work. And so you can't just get something for nothing. You have to actually invest money in it. It's the same thing with Bitcoin. So miners use energy, they use electricity to solve complex mathematical problems. Very similar to mining gold. It's just in a different format. It's in a digital format. So the Bitcoin mining market regulates itself by balancing three things, okay? The cost to mine. So if energy is too expensive, it'll cost way too much to mine Bitcoin, right? Unless Bitcoin is really, expensive, right? Quote unquote expensive when compared to whatever currency you're using. So let's say if Bitcoin goes to $100,000 per coin, well, now it might be worth it to spend 12 cents a kilowatt on energy. Versus if Bitcoin is maybe at 16,000, 3 cents a kilowatt may be too much, right? So there's the balance between the cost to mine it. Now, mining costs money, right? You have to buy these miners, these special computers that are dedicated strictly to solving these mathematical problems that get harder and harder according to the algorithm the longer this goes. So it's not easy to mine. So you have to dedicate a lot of resources. Those are expensive. Then if it's worth it, right, then there's going to be a ton of people all competing for those same 12.5 Bitcoin every 10 minutes. So the more reward there is, the more miners, which if there's more miners, that's less chance that you, if you're a miner, will have a chance of reaping that reward. So that's kind of, supply and demand, and it regulates itself. So if things get cheap, then you have a bunch of people jumping in it. So whether it's the cost to mine, the rigs, to do the mining, and it's cheap relative to Bitcoin price. So if Bitcoin price goes way up, the reward goes up, and so you'll get a bunch of people jumping in. If it goes low, you'll get a bunch of people jumping out. So in our next video, we're going to be talking about acquiring and storing Bitcoin. So now, just to review real quickly about Bitcoin, don't confuse mining and the blockchain, right? Remember that blockchain was that notebook that we passed around to build that linked set of sentences. That's just the blockchain. But the mining is actually converting that energy into Bitcoin. So we're going to be talking about how to acquire it next, and then what to do when you need to store it. See you on the next video. You've been listening to the Wealth Architect Podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.